Welcome to Beyond Six Figures, the podcast that helps business coaches to micro-niche, get noticed, and become fully booked. Learn from top industry leaders who've successfully taken their businesses and their lives beyond six figures. Get ready to level up your coaching business and make this world a better place, one business at a time. And now, here's your host, Ziv Raviv.
Welcome to Beyond Six Figures. Our guest today is Thorsten Claus, founder of ThinkStorm Ventures and a seasoned investor who has helped build funds from $100 million all the way to over $1 billion, with a background that bridges engineering, venture capital, and strategy. Thorsten focuses on resilient systems and ethical investing, helping founders and funds thrive even under uncertainty. Today, we'll dive into how he approaches building long-term value, aligning capital with impact, and guiding companies to scale responsibly. Hello, Thor. How are you?
Hi, Ziv. Thank you. Yeah, I go by Thor nowadays. No.
Yes. Thank you. So Thor, Claus, thank you for taking the time to connect with us. A lot of business coaches get this question occasionally: when is the right time to approach and find an investor? And you look into companies on a daily basis and in making decisions whether you're going to invest or whether you're going to advise people to invest. Tell us a little bit about the parts in your journey that we can talk about. What brought you to become an investor?
Oh, sure. So, I stumbled into this, like I heard most VCs, actually. Most of the VCs I meet did not dream as a young child of, I'm going to be an investor when I grow up, right? So it's not really usually you dream about being a fireman or doing something exciting or being an engineer or something like that. So I really stumbled into that. And that was mainly because at the time I was creating very large data centers, so 20 petabyte upwards, which in around 2000, was a pretty large number nowadays. It's pretty normal. And the traditional solution providers, the traditional tech companies just couldn't provide the tech I needed. So I turned to startups, like very young companies that had a groundbreaking scientific discovery or some different way of solving a problem that was incredibly efficient or novel or different way of thinking about IT infrastructure. And these startups that I worked with, and that's how I got to know startups. And of course, when you write like $10, $20 million checks for your projects, then the VCs really like you because you make a lot of money for them. And so that's how I stumbled into the venture capital scene. And for me, it was incredibly fortunate that T-Venture, the venture capital arm of Deutsche Telekom back then in 2010, gave me the opportunity to start here in the Silicon Valley. I was there for 10 years, but the venture capital, and really gave me the opportunity to train me and spend a lot of time with me. Georg Schwegler was really instrumental for that and really grateful for him to introduce me to that. But your question was about, how do I find capital, right? Or when do I reach out for capital? Or how do I even do it? And I think the first thing to understand is that whether you are a young startup or a deep tech startup or a business coach that finds an interesting idea in one of your clients, is that you have two products. You are selling widgets to your end customers, whatever that might be. Could be coaching, could be software, could be hardware. And you're selling a financial product to the investor. And those two have to match. And most people only think about the great thing that they're doing, forgetting that they have a customer on the other side. A customer might be a bank. So your business product in this case is I'm very stable, I'm predictable, I've got assets as in the background, I've got a business plan, and here's what I did in the past, very cookie cutter. So that the bank says, yeah, that makes sense. I can give you a loan, and this is the amount because I'm managing my risk. Or you're saying, well, maybe you're a private equity investor, so you take more risk, but not the hyper growth risk that venture capital takes. In that case, the financial product looks very different. And understanding what motivates that investor, what is it that makes them tick? Where is their money coming from? Is it their own money? Is it the bank's money? Do they have investors themselves called limited partners, LPs, who give them the money? And what did those people task them to do? And where is the fit? That's really key to finding great investors, because otherwise you're barking up the wrong tree.
That's already a very useful insight. What you're saying is basically the different ways to get to ask for money for business reason. The bank might give you a loan. That by itself is a type of investment in you. And they might have their own type of reasoning based on your data points, based on your operations. But then there's like investor companies or an investor that might have partners with them. That will be a different type of level of a risk. And there's also the chances of like a one sole investor. And they're going to be even more careful with risk taking. What do you think, based on your experience, is a minimal viable business to actually start this conversation, to even consider talking with this?
Yeah. So I would maybe approach it differently than many other investors, because in the beginning, you might not know if this is a venture capital business or if it's a lifestyle business. This has two main opposite sides basically of the same thing, where a lifestyle business is something that grows very comfortably, becomes cash flow positive, it pays for your employees and salaries, and you will grow step by step, probably linearly, or maybe initially some exponential curve, but then pretty much linearly. And there probably is a ceiling of that like a revenue ceiling or a number of employee ceiling that you're comfortable managing. And that's going to make very good money. And it's going to be, as I said, cash flow positive. But this is not the hyper growth that venture capital requires. And venture capital, on the other hand, most venture capital firms, and I'm generalizing here a little bit, so bear with me, require a hyper scaling of your revenue, meaning usually this is the 1-3 notion, the 1 million to 3 million to 10 million to 30 million to 100 million. It's not quite like that, but it gives you an idea how fast you need to scale your revenue. And the reason is the ultra high risk that venture capital is willing to take. And in order for that risk to actually pay off, because 80% of startups die, they need an ultra high return on the other hand. So venture capital is dominated by outliers. What that means for you, so you need to understand that motivation first before you think about what's the right timing. So what that means for you is initially you might not know, am I really hyperscaling, or is this going to be just a great business? Because once you get an investor on board who is interested in hyperscaling venture capital, there's no way of going back to become a regular business. So maybe in the beginning, you can start with 2 people in the same room who have an incredible insight about something that no one else has, or at least they don't know about it, or some sort of a business advantage that you two think you can solve. So I've seen incredibly successful startups where 2 founders came together. One was, let's say, an incredible salesperson, and the other one was an incredible user experience designer. And they said, between the 2 of us, we're going to find a really valuable problem that we're going to solve, something that people want. We don't know yet what that is, and so we're going to start. And then you start ideation phases. Basically, what could we work on? And at some point, you find something that's incredibly valuable, a real need. That's usually what in venture capital we differentiate between the vitamin and the painkiller. Vitamin you take, and yeah, it's nice, it's probably healthy. Oh, I don't really need it, right? I could also go a day without it. And the painkiller and medication is what you're looking for. And that's the point where you can look for investors. And my advice would be to go to angel investors or small personal business people, maybe friends and families and fools, the FFF, if we call them, friends, family, fools. So start there, because if this becomes a very profitable business that doesn't hyperscale, these people are going to be incredibly happy with the outcome, because you're going to give them cash at some point. It's not the hyper growth institutional venture capital, but they're going to be very happy to be part of this journey. And then maybe later on you discover, wow, I think this is hyper scalable. I think we can make this like be the next rocket ship. Of course, then you go to venture capital, probably who have a higher risk tolerance than the traditional business banks, I would say. But to answer your question very shortly is, as soon as you find something that you believe, you have conviction for some reason that this is something that no one else has really tackled and it's a dire need, there's a real quantifiable value proposition, go get funding.
What do you think about, as a VC, as a venture capital, what do you think about a business owner that comes to you and say, yeah, I think I have a solution that is hyper scalable, and you ask them, do you have any loan from the bank? Did you try to sort it out first with a bank? And he says, no, I'm going directly to you. Is that a criteria for you to show how serious they are?
No, I think if you need to fund your operations somehow initially when no one else believes in you. That's really the risk, because in most businesses we start that are transformational. So I'm not saying opening yet another pizza store or opening yet another retail store, right? But something that's really transformational, where you think you're going to do business significantly different. Most of the times you don't have a technology yet that works. You don't even have a product yet that works, right? You're designing it for a market that doesn't exist and customers who don't know you need you. It's pretty rare, right? And so can you convince at least one other person to work with you on this, even though there's no money yet, right? You both are living off your savings, basically. And the reason that this is a good criteria to look for, sometimes it's a co-founder, sometimes it's someone who just works with you, it doesn't have to be a co-founder. The reason that this is very important is because someone else believes in that idea and you were able to articulate that idea. And I think that's a very important part. Not only do you have to yourself believe in it, but you have to be able to articulate it to others and be enthusiastic enough to excite others, even though there's no clue if this is going to work out. That's a good criteria, I think, to start. So if you convince the bank to give you a loan, hallelujah, that's a great signal. If you convince someone else to join you, even though there's no money, great, right? If you get a business grant, man, you have tenacity and apply for a loan program and do all the paperwork, even though you don't know if this is going to work out. So yes, there's time invested, and that's a good sign.
So there is a way to kind of signal the VC that you're serious by either using the FFF, the friends, family, and fools, to invest in us, or get a loan, or even if you're showing how serious you are by putting your own capital into this for a while. But eventually the VC will decide based on hyperscalability and the level of risk. So I want to ask you about that for a second. Will the VC care about other things apart from the gain and risk? For example, the team size and the SOPs, the procedures, or the processes, and basically, like how will the VC assess the company is ready beyond having the potential?
Right. So that's a very difficult question to answer because we operate under a significant uncertainty. So we're in the same boat, right? We're trying to invest in companies for these markets that don't exist, for customers who don't know they need us yet, right? And so we're trying to find these ones. And that means that we also have a limited number of shots on goal, so to speak, right? Usually funds, when you're talking about an institutional VC who has other backers behind them, the limited partners they call it, right? Usually 90 or 95% or 98% of the money comes from these LPs, and 2%, 5% is their own money. That's usually the ratio to think about, right? And so I might be able to make 20 or 30 investments from that fund that someone gave me, so to speak. 30 companies out of the 16,000 that are founded every year in Silicon Valley alone. It's not statistically significant, right? So you have a very small sample size, and you need to, as VCs, find conviction. And how you get there varies widely from VC to VC. I think what is common, though, or seems to be common, what I can see, is that people want two things really from the first team. They want ability to communicate clearly what the value proposition is. Many people forget that. And value proposition is quantifiable. And maybe initially it's backing into a story or it's a narrative, but it's a quantified need that gets articulated. Number two is this the right team to execute whatever needs to be done? So why has no one done that if it's so obvious, right? You're saying, hey, there's a huge market and everyone is doing this over here. And why is no one doing this over here? It's so obvious, right? So what's really hard, or what's NP hard, non-polynomial hard, right? And if you have something that's so hard, is the team the right one? So I'll give you an example. You're a young student and you're saying, I want to have this business. I learned all about it. And what's really hard is machine learning and LLMs and the math behind it. And I have a major in cooking. And my co-founder is an MBA. I'm saying, shit, it's not going to end well. If the really hard thing is something highly technical and you don't have a technical founder, how is that going to work out? Tell me more about it. I'm a little bit skeptical here, right? And so it's the ability to execute. It usually comes with a unique insight that you yourself might not be able to articulate initially, that you stumble upon. They say, shit, man, that's right. It's so intuitive for me because of my history of what I did. And by the way, this might be people who did fundraising for the church group, for example, or they had a e-learning group during COVID somewhere at a local high school, and they realized I have a knack for teaching, or I have a knack for this other thing. And so these are great proof points. And so if what is really hard is exactly that, that's an amazing signal for investors, because it's not just a wishful thinking. It's not just, oh, wouldn't it be great if we could? It's like, yeah, it would be great, but you're not the right person to execute on that. And I think that's the connection you need to make. What's hard, and why do I believe you can solve what's hard?
So let's say the listener is a coach. They're working with a business that is looking amazing. There's a match between the skills of the owner or the CEO or the founder and the type of skills they need to succeed in solving a big problem, a problem that no one solved yet, that a lot of people need. They don't even know that they need it, but they need it. And there's an opportunity for hyperscale. So all of these are now in alignment. Where do we actually start? Is there some sort of choosevc.com website, or where do we actually go to just start a conversation like that?
Yeah, so there are several different ways to do that. Number one, you need to know which VC invests in my specific area. So if you can do sales automation on LinkedIn, it's great if you send out 1 million emails, and that might work. And there might be some that actually are a match. It's very rarely the case, right? Because you would send something to me, let's say a consumer business, but I don't invest in consumer, right? I will never respond to you. And it's like, man, no one's responding to me. So what you need to find out is, what is the specific VC tasked to invest in? So is it really the area that would be applicable to you? The next thing you can do is you can look at companies in the same space that might got funded like a year or two ago, and you look at the investors who invested in that. It's probably a good start, right? So hey, they invested in something similar like that a year ago, so maybe they're still doing the same thing, right? The next thing I would do, and I think that many people forget, is doing background checks on the VC. And it's actually much more simpler than you think it is. What is very intuitive is you call the companies that VC invested in. So you know who they invested in. You can use Crunchbase, you can use PitchBook. A lot of universities, by the way, have free PitchBook access, right? And you can use these databases in order to find out who are the investors, what did they invest for, which other companies did they invest in. And you call those CEOs. And all of those were at some point in your shoes. They didn't have funding. They were looking for funding. And they will help you. I want to say really 80% will pick up the phone and says, oh, yeah, I was in the same boat. And what you can say is, hey, I met Ziv. Ziv is an amazing person on the website. We have appointment set later on, and talk about investment. What type of investor is he really? And if the startup says, well, he's mostly on time, it's not a good sign, right? Maybe you want to move on. But maybe they say, oh, he's incredibly technical. He likes to do technology. And what he's really good at is, and then come maybe two things that they're really good at: product market fit, pricing models, and consumer, or something like that. And then you think about, is that really the key problem that I'm struggling with? Because usually you do something that's incredibly hard, NP hard, remember? And that's what you're good at. Great. And then you have some challenges. For the challenges, you usually have some advisors who help you with challenges, but there might be one or two challenges where you don't know yet. And if the VC has exactly solved that challenge for 6 other of their startups, oh my God, that's a gold mine, right? Because you're going to call them and say, we're going to do this thing that's incredibly hard, but don't worry, we can do that. We have 3 challenges. 2 of them are covered by advisors. Don't worry, not my problem. But the third one, it's really interesting. I'm always struggling with pricing. And I heard from Jeff and Joe, right, for your other investments, and Sarah, that you really help them with pricing. Tell me more about this. What did you do? Why did you do this? And the VC will say, oh my God, that's what they're struggling with? I'm going to make 5 phone calls. I'm going to make the 2 introductions that I always do. And then I'm done. I can go home play with my kids. So that's also the way to get the intro. Because if you are truly doing something amazing, and you can convince, coming back, remember, to the storytelling and convincing others to join you. If you convince these other startups to say, wow, Ziv really has a good idea. I should tell my investor actually that this guy should talk to Ziv, right? He's really good. And then he hears from 3 different areas, from 3 different people. It's like, oh, you should talk to Ziv. Of course he will pick up the phone. And that's the easiest way to get an intro, even if you have 0 clue about venture capital.
I love it. I have a question about, as an investor, as a VC. On the one hand, it's kind of expected that some of your investments will not bear fruit. Business is hard. The statistics in general in business are hard. And we're here talking about investing into a company with hyperscale opportunities, but with also some risks. Yeah. There's a reason why they need the capital. So, and as a VC, you actually are not only using your money, you're putting maybe 5% of the investment, and you have all these LPs, and they're not going to be happy if their money is going to go down the drain. And I guess the VC want to be successful enough so that they stay with him. In order for them to stay, the VC needs to be able to make money for those LPs. Yeah. But failure will happen. How does the VC deal with that?
Yeah, so badly, in a short form. So I wish I could give you a quick answer here. There are 2 things I think that are important to remember. I never promised my LPs the performance of a single asset, for the lack of a better word, right? Because depending on the company, call it asset, right? So I have a portfolio of assets. I've got 20 companies, 30 companies, 10 companies, whatever my portfolio is. And what I said to the LP is, I'm trying my utmost best that this portfolio of company performs well. Now, it depends on the VC. And by the way, that's a great question also to ask if you're doing your research on those people. What's the risk profile of this VC? Is it, for example, a corporate VC who can't lose a single deal? Because, like you said, man, I cannot lose anything. My company that's backing me is going to go berserk, right? Do the LPs have an incredibly high risk tolerance, saying, you know what, even if 90% of the startups fail, we don't care. Yeah, that's what we underwrote. You're doing moonshots, you're doing the difficult deals. We know there's going to be a lot of failure. We're fine with that, as long as there's 1 or 2 complete outliers. So these are the 2 ends of the spectrum, right? And so how do we deal with failure? So there are 2 types of failure. There's failure to listen, and there's failure to execute. If there's failure to listen, if you as a business owner or founder are unable to hear what concerns the VC, your investor and shareholder has, then they will abandon you and you will have zero help and there will be no exit help and you are all by yourself. And it's even worse, even if you think you found a good deal, the VC might say, nah, it's a terrible deal. I'm not going to do that. And I'm a shareholder. I have some rights here that I underwrote, right? And so very, very bad failure in that case. The second failure is if it's really not hyperscaling, you need to identify that early. You might be able to pivot. You need to find then maybe another area where you can apply the same technology or similar technology. Or you might actually say, you know what, we're actually 18 months too early. We have to go into hibernation and have everyone go, cut deep and cut fast. And then we're going to survive on a shoestring budget. We're going to be very quiet because we know the market is going to come to us. I was just 18 months too early. And then you're going to continue. Usually, neither one of those two things is going to happen because you're very enthusiastic about your thing that you're doing. And usually you can't let go people because you have never done that before, probably as a first-time founder. You never hired and fired people. And so I would wish that any business coach would really teach people how hard it is to hire and fire people, what the implication of hiring is, how serious hiring is, what responsibility you actually have after that. It's incredible. And I think these are the things that we should really think about as business coaches.
This goes all back to the idea that you need to hire people that are better than you and stronger in some way, so that they actually you are creating a winning team, and a team that is not dependent on this one person, because this will be very hard to scale. So, Claus, this has been fascinating to connect. Where can people go and check ThinkStorm and just learn more about you?
Yeah, I think there are like really three ways. Number one, my blog, blog.thinkstorm.com. I post like once a week approximately, usually like once or twice a week. And that will tell you a lot about how I think about investing. The second thing is reach out to me when you're in San Francisco. I am very easily accessible. My contact information is on the website. It's going to be on LinkedIn. And so very easy to connect. When you hear, I'm going to make time and meet you. And I meet many entrepreneurs, whether they're an investment target or not, whether they know if this is a business or a startup or not, whether they want to go into VC or not. Super happy to share any insight and help others, especially for people outside the Valley, where Silicon Valley seems to be like a mystery and very opaque and shrouded with like stories and myth, so very happy to add some transparency. The third thing is connect with LPs, connect with people who give money, connect with people who are investing, and ask a humanistic question, not a technical question. Don't ask them, how did you invest? What do you invest in? Hey, what's your target? Ask about, how did you become an investor? What books are you reading? What are you interested in? How did you decide who to marry? How did you decide to go to Greece for vacation? What's your dog's name? So really be interested about a person and learn about what motivates investors. And that usually will lead you one way or the other to me or others, because it's actually a pretty small community, right? Investor community. And if you really understand what motivates people, where they're coming from, it's much more likely to have like an incredible insight that you otherwise would have never gotten, because the technicalities of investing you can learn from a book. You don't need to ask a person for that.
Thank you so much for being so generous with your time with us, and for inviting people to connect Thor. We will put the details of Thor, Claus on the show notes and of ThinkStorm VC. This has been fascinating. I think we've learned a lot. I want to thank you, everyone, for listening for another episode of Beyond Six Figures.
Thanks for listening to Beyond Six Figures. Check out the extended show notes that include bonus material, practical tips, and exclusive resources on our website, zivraviv.com. Until next time, keep dreaming big and pushing your business and your life beyond six figures.